Hey everyone, welcome back to another dividend investing video. Today I'm going to make a change in my public YouTube dividend growth income portfolio. I'm going to be selling out of a small position here in the next few weeks, and I'm considering 3 different options for those funds. Today I'm going to go over why I'm selling out of this stock and briefly look at each of the different options I'm considering for this money. This is a portfolio I started about 9 to 10 months ago with the intent on creating a passive income machine using dividend growth stocks and ETFs. And I'm making everything public here on YouTube to let you, the viewers, follow along in the buildup of a new dividend portfolio. So let's get into this. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So the stock I've decided to sell out of, it's not AT&T or Verizon. These stocks have been awful performers over the last quarter and really over the last 5 to 30 years, really. They've been terrible dead money investments. As of now, I'm holding my small positions in both of these and keeping an eye on these over the next year. I'm not adding to them at this time. But the stock I've chosen to exit out of right now is Walgreens Boots Alliance, ticker WBA. No surprise to our regulars here on the channel. I identified my buying into Walgreens as a mistake, and it was an unnecessary stake, a yield-chasing mistake. I'm really looking to avoid these kinds of companies that don't bring in positive returns. I want highly profitable companies with growing free cash flow. Growing free cash flow is what allows a company to grow its dividend. Walgreens' free cash flow is trending in the wrong direction and dividend growth has slowed to a crawl. In fact, just last week, the board announced its next dividend payment would be in line with the prior quarter's pay. Normally in July, Walgreens announces a dividend hike. That's been the case for the last 20 years until just last week. But free cash flow does not cover the projected dividend payout for the next year. Free cash flow per share right now is at $1.83 per share. And the dividend payout is projected to be $1.92 per share. So you can see the problem there. Operating margins are getting squeezed. Retail always runs on slim margins. That's just a fact of that industry, but this is really getting ugly. And they carry a lot of debt, more than $37 billion in debt. We could see them taking out even more to keep paying this dividend, a dividend that management says they are committed to. And sure, that 6.49% yield looks great, right? But if you're losing 42 to 43% of your investment over the last 10 years, then who cares, right? This chart speaks for itself. I want companies that aren't dead money, that do have a track record of bringing value to shareholders, and Walgreens looks like a dying business from here. And I don't think it's going away necessarily anytime soon, but think about your own experience. The last time you went into a Walgreens, right? What do they really provide? They have a ton of stores. Just about everything they sell is extremely overpriced. You go to Walgreens out of convenience or to get your drug prescription filled. Not that there aren't plenty of other options with services that allow customers to have their meds shipped discreetly to them, but going to Walgreens is usually a terrible financial choice. They have plans on scaling their health services businesses, but maybe that's where their future lies, but this has just taken longer than expected. I can't justify holding this business anymore. In our weekly recap video last week, I was talking about the latest Walgreens dividend and my plans to sell out of it to watch out for this video. And in that same video, I quoted Warren Buffett saying, be greedy when others are fearful and fearful when others are greedy. And our loyal viewer, commenter, Xander, and I hope I'm saying that right, called me out as being fearful for deciding to sell out of Walgreens. And look, I can see that point of view, Xander, but really, I don't see this as selling out of fear, but loss of conviction, right? I'm not selling and stashing this money into my mattress or in a savings account. I plan to reinvest this where I have higher conviction. Now, maybe Walgreens recovers, but I have no faith in the company at this point. I just don't like it. As what I will do with the funds, I've narrowed it down to 3 choices after ruling out one specific choice. I think a lot of folks would look at a Walgreens investment and say, hey, why not move that money into a competitor, CVS? Well, I'm not going to consider this for 2 reasons. The first is that my reasoning of getting out of Walgreens is that I'm already quite retail heavy in my investments. In this portfolio alone, I'm invested in 4 different retail companies. Granted, they're all different and they have their own purpose, but I think this portfolio is good on retail. I don't need 4 of them in this account. The other retailers I have in this portfolio are Kroger, Home Depot, and Best Buy. I consider the first 2 high conviction investments, Kroger and Home Depot. Best Buy, kind of more higher risk, higher reward type play. But all 3 of these, vastly superior companies and financials to Walgreens. And this makes up a nice chunk of retail for a dividend portfolio right now of this size. Now, CVS, I also see having some of the same long-term problems as Walgreens has, although their stores are not as run down generally, just from my own experience. And they benefit from their alliance with Target, ticker TGT. They also have a health insurance business, so they're better developed on the healthcare side of things. They're a much better run business. Maybe if I wanted to keep my investment in retail, maybe healthcare related, it would be on the table. So today shares are yielding 3.35% for CVS, 22% above its 5-year average, trading at a forward PE of 8.4, and this is a nice discount to its historical 5-year PE of 10.1. It's a safer dividend than Walgreens. SimplySafeDividends.com gives it a safety score of 90, and dividend growth is also more promising. Their latest dividend raise back in December 22 was a 10% raise, so this isn't the worst choice to replace it, but again, it's just not for me right now. So the first option is SCHD, the Schwab US Dividend Equity ETF. It's the largest position in the portfolio today alongside VYM, both of them making up a little bit over 10%, pretty much an equal way. I've been actually buying them at equal amounts. And really, I could just split my Walgreens money between these 2 ETFs. I think that is probably the solid choice, probably my most likely choice. Investing in these ETFs, I don't have to worry about one individual company going to crap like Walgreens. Now, dividend ETFs like this are set it and forget it kinds of investments in the truest sense to me. It would knock my yield down a little bit, but that's okay. The dividend growth rate on SCHD has been averaging 14% year over year, and I know it's not going to be dropping 30-40% in value. So overall, far more sensible investment. So why SCHD? Well, it provides what I call the golden trifecta for dividend investors. You got long-term returns comparable to the broad market. Today here you have a 5-year chart comparing SCHD's total return to that of SPY, the S&P 500. It's just a few points shy of investing in SPY, and it should outperform it in bear markets. Secondly, the yield from SCHD more than doubles what you would get investing in SPY. Currently, it's yielding 3.55%. And finally, it features above average dividend growth, the kind of dividend growth we see with SCHD. It's hard enough to find in individual stocks consistently, so finding an ETF that does this is pretty fantastic. I toot SCHD's horn enough on this channel, so I really don't need to go too much further. This is a safe go-to for any kind of dividend investing money, any kind of funds you want to get invested. If I'm not seeing a stock I really want to buy, just buy SCHD. Of course, I am already buying a ton of SCHD this year. I've so far purchased 29 shares. It's a little over $2,000 worth in my Roth IRA this year in 2023. Buying 1 share in that account every single week. So already buying plenty of it. So what else am I considering? Well, I've mentioned the second option a few times in recent videos, and that is Vici Properties, ticker VICI. Now, while Vici would be a new position in this portfolio, it's not a new position for me personally. I have been buying it in my Roth IRA for the last couple years, alongside a few other real estate investment trusts, with basically the money that doesn't go into my weekly SCHD share in that Roth IRA. I buy most of my REITs in the Roth because of tax purposes, but I would like to go a little heavier on Vici Properties and becoming a higher conviction company for me. So I'm thinking about building out a supplementary second position here in this YouTube portfolio. Vici owns casino properties, world-class resorts. Many of the famous hotels that line the Las Vegas Strip are owned by Vici Properties, so buying Vici, I'm getting a cut of those rent checks in the form of dividend payments. Betting on Vici's to me is betting on American tourism, and I'll take that bet. Vici has only been around a few years, therefore it lacks the track record of most of my usual investments, but I feel comfortable investing in this industry as I have some connections to it. Now, shares are yielding 5%. In that respect, it replaces Walgreens pretty well. Dividend growth prospects also are way stronger. Overall growth prospects look way stronger. Debt's a concern. I'd like to see them reduce it, but high conviction for me next decade and beyond. I think their market cap is going to blow far past the current $30 billion over that time. Now, I mentioned Vici will be a stock I'm buying in July during one of my latest videos, so I'm definitely adding some in my Roth this month, but don't be surprised if I also start buying it here in this YouTube portfolio in the near future. It could replace my Walgreens investment in there entirely. Alright, the third option is another ETF, I'm thinking about adding the Vanguard International High Dividend Yield Index Fund ETF, ticker VYMI. My reason for considering this, well, the portfolio has no international exposure whatsoever, aside from Medtronic, which is based out of Ireland, but I kind of still consider them more of an American company. So adding an ETF like this is going to give me that international exposure I'm severely lacking. It's no secret that US stocks have long been outperforming international stocks in modern times recently, but that will not always be the case. So this fund tracks the FTSE All-World ex-US High Dividend Yield Index. So all the dividend-paying companies outside the USA holds 1,392 individual companies. Let's take a closer look here. Shares are yielding a surprising 4.45%, higher than either of my other dividend ETFs, SCHD and VYM. Has an expense ratio of 0.22%, which is a tad on the high side, perhaps compared to some others, but this is still in a pretty reasonable range. It's $22 for every $10,000 invested, is what that would cost me. Now, to do a breakdown of its holdings, it does have a ton in financials, 35.05% of the fund, followed by a little more than 10% in energy, 10% in industrials, 9% in basic materials, and this is another sector I am lacking in, 8% in consumer cyclical, and 7% in healthcare. Here are the top 10 holdings. Pardon me, I'm going to probably mess up most of these pronunciations, but the top holding is Roche Holding AG. This is a Swiss pharmaceutical company. The next is Shell PLC. They're an oil company based out of the UK you're probably familiar with. We have Novartis AG. This is another Swiss pharmaceutical company. Then we have Toyota Motor Company out of Japan. HSBC Holdings, which is a large bank out of London. Then we have BHP Group. These are a mining company out of Australia. Next is Royal Bank of Canada. It's a bank in Canada. Canadian banks are excellent dividend companies. Really, I think that's going to be another video I needed to put out as a video on all the Canadian banks that's in the plans. This fund also contains Unilever, a very popular consumer goods company from the UK. There's also French oil company Total Energy, I guess you'd say, or I don't know how that's said. I don't know anything about French. And last is Sanofi SA. They are a French healthcare company. So I really like the idea of adding an ETF like this. If there's a downside, it's not really a dividend growth ETF. The dividend with these foreign companies is a lot less consistent, looks like. So this would bring some unpredictability to my forward income, and I am a guy who does like boring, consistent, predictable, but it's really hard to deny the utility of having this international exposure. So I have to consider this. Let me know down in the comments, what do you guys think? Would you be holding Walgreens? Do you like my 3 suggested alternatives, or maybe you like CVS? What do you think is best? What do you think? I'd love to hear feedback, and I appreciate all the fantastic interactions I have with each of you. 99% of you are super respectful and polite, and I really do try to address every comment as long as you're not rude. I do plan on selling out of this Walgreens position in the near future, probably before the end of this month, if not by the end of next month. So you'll see which way I go pretty soon from my next portfolio update video, which is I'm always good about getting those out at the end of the month. You guys seem to like that series. Now, if you want to follow what I'm doing in my Roth IRA, this is another account I'm investing in, a retirement account. Click on the link to this next video here, where I am going to give you my mid-year review of that account. You'll see all the SCHD I've been purchasing, the Roth IRA. I've also been purchasing my REITs. So thank you for sticking around. Have a wonderful day. And until next time, keep investing.